quickly, Doug Flynn is with us from Flynn, Zito Capital Management. Doug, just quickly here, it's more than a distraction, but how much should investors really be paying attention to what's going on in Europe as part of their daily or monthly, self-portfolio updates?
Well, I mean, most people have some level of international securities in their portfolio if they're invested and diversified properly. So, I mean, you look at that perhaps as an opportunity longer term, but in the short term, you do have to be concerned because there are the fears of a global recession that are popping up again and putting pressure on the market. So, I don't think you lose sleep necessarily, but it's something to take a look at.
But there's clearly a lot of noise. I mean, we're up 26 one day, we're down 130 points the next here, and a lot of it is hopes and fears and optimism. And all this being bandied about sort of brings us to portfolio management, which is the reason we brought you in today, because you look at stocks, you look at an Apple, and Apple's been a great investment for people who've held onto it for a couple of years, or even who just bought into it after the Great Recession. But then what was maybe a 5-6% holding in your portfolio, suddenly 10, 12, 15%, depending on how much you owned. And you say it's wise to sometimes start pruning it, not letting it just keep run and run and run.
Yeah, that's right. What happens is there's many reasons to sell a stock or a fund, and only one of them is performance. But one of the things you want to do is take a look at it. If it becomes too big a part of your portfolio, that's an ideal time to relook at it. And there are times like that stock, for instance, if it's off $100, you might look at that as an opportunity to buy more. But would you buy more if it's already 10, 12% of your portfolio? No. But if you had trimmed it as it moved up, back down to 3 or 5, then if it does sell off a little bit, that's an opportunity to go back in. You could make a good decision to go back in and add to something when it's not already overweighted in the portfolio. And that's what happens. People end up not being able to take advantage of those things because they let it, become a situation where it wags the dog.
Now, sometimes people just sort of don't pay as much attention. They don't follow it day to day, or maybe they don't know, when to unload. I mean, I'm sure there's not a one-size-fits-all strategy, but what is a sell strategy that's sort of a general idea here? Do you look at something getting greater than 10% in your portfolio as sort of a benchmark to step back and look at it?
Well, on a stop loss scenario, I only want to lose a certain amount of money. That's one easy way to do it. I'm going to go in, I'm going to accept maybe a 20% loss, and then I'm going to let it you get out of that and revisit it.
But it seems harder to sell a winner than a loser. A loser, people, maybe they want to get their money back, but a winner, you're like, hey,
Yeah, I think about...
leave money on the table.
Yeah, in the late 90s, early 2000s, I remember trying to get people out of Lucent. It was a good stock.
Yeah.
And there are several like that had they done that, they wouldn't have suffered the ultimate drop.
JDS Uniphase, you can think of a lot of them.
Exactly. And so you have to just take a look at it and say, what we do is we take a look at the targets of the stock and say, what do I expect out of it? And then what we do is we revisit it. It doesn't mean an automatic sell, but you relook at it. And one of the easiest ways to do this is to say, would I buy it again now at the current price? If you would not, forget what size it is in the portfolio, but if you would not buy it again now, that's the first indicator that maybe I should start looking at it. And then it's rules of thumb. Trim it to 3 to 5%. That's what professional money managers do, and you should probably mind that to some degree as well. It's a good starting point.
Now, as part of portfolio management, we were talking a little bit about Facebook, and so if you did participate early and you loaded up, then you're probably wondering what to do right now, wondering about a sell strategy, but you're also not necessarily going to want to add to the positions, even though it's now below. If you loved it at 38, shouldn't you be liking it even more at 28?
You should, right? That's right. Now, we can get into whether or not, paying 70 or 80 times earnings for the next Apple or Google, which are trading at 10 or 12 times earnings, is something you want to do. But yes, you cannot add to it if you load it up on something like that with the hopes that that's bets, that's gambling.
Right.
But if it was a small percentage of your portfolio and you added it because you like the opportunity, this represents an opportunity perhaps in the long run. Maybe it's going to go lower, but you have to accept the fact that you might not have, if it goes up and it doubles, yeah, you would have made more money had you done more of it. But I often advise people to say, listen, whatever you're thinking of going in, go in about half. If it goes up and it gets away from you, there's always something else to buy.
Right.
But if it does come down, then go in with the other half. It's an opportunity to average down your cost on a buy side.
All right, let's talk a little bit about taxes. We have no idea for, I don't know how many years running now, what our tax policy is going to be next year for investors. You're advising some folks to accelerate gains into this year to pay the known versus the unknown.
That's right. So we're rebalancing a portfolio. Like in the last 12 months, growth stocks are up 9% and value stocks are down 3%. The market's up about 2%. So there's perhaps some gains on the growth side of your portfolio. Most people just let them go. But if we were to take advantage of that and create some gains, we start rebalancing to take advantage of those things. You start saying, well, I might create some gains in the portfolio and the person has to pay taxes on it. So we have this conversation with clients, and as we're going through, we're saying, you know, wait a second. If you have gains in the portfolio and you leave them, and then you realize them next year or the year after, you could be pushing off a tax bill, a higher tax bill, when you go realize them. So as we're going through it, we're saying maybe we start realizing more of them. Right. Most years, at the end of the year, we go through and we call it tax loss cultivating. We go through and we pick off all the losses and try to book those. This year, it's kind of the opposite. Maybe you get in there and you aggressively take the gains, book them at the maximum 10 or 15% capital gain that you have, because it's a knowable.
Right.
We may have
versus
that
a possible 45 for dividends next year. Who
dividends,
knows?
and then you have capital gains maybe going up, and then the surtax for the health insurance. So you're saying, you know, if I have the wherewithal and I can do it, it's a strategy where several clients we've had the conversation with and have said, you know what, take me out, let's reset at this point in time, and I'll pay the taxes, and now I only pay from here in the future at whatever the future rate is. Because if you're sitting on a $100,000 gain and you delay it a couple of years and tax rates go up, you've lost that 15% capital gains rate.
Well, Doug Flynn, we'll have to have you back when we have a little more visibility, or if we don't, to revisit this and some other strategies as well. But he's with Flynn, Zito Capital Management. Thanks so much for joining us here on FoxNews.com Live. The Dow is now down 133.